So after working with hundreds and hundreds of people, I have seen the same costly money mistake over and over again. And do you know what? I can almost guarantee that you're probably making it right now. See, most people think they're being smart with their money, right? But they're actually leaving thousands of pounds on the table every single year and getting in their own way when it comes to just all things money. More specifically, how to make best use of their income. Put simply, this mistake is costing you a fortune. So today, I'm going to reveal what this massive mistake actually is. And it's something that is so obvious that once you see it, you can't unsee it. And it's something that most people completely miss. Then I'm going to show you exactly how much it's costing you. And finally, I'm going to give you a simple fix so that you can implement the changes quickly and easily. So what is this massive mistake that is costing you thousands of pounds? Well, let me tell you a story that I guess completely just changed how I think about money completely. See, when I first started working in finance, I did what most trainee financial advisors do. They became what's called a power planner, right? Think of a power planner a bit like a paralegal. You've probably heard that before. So instead of in the law profession, it's just in the financial advice profession. So you're kind of doing all the research, you're doing all the planning, you're doing all the number crunching for senior financial advisors. And one day, one of the senior financial advisors at the firm that I was working with at the time gave me what I thought was a simple task, right? He wanted me to optimize a couple of projections for clients. Basically, just figure out what was the most effective way to convert their income into lasting wealth, right? So I spent hours, and honestly, I literally mean hours, doing things like cash flow modeling, tax flow optimization, forecasting scenarios, all of these jazzy words, right? They don't really mean anything to most people watching, but I was absolutely kind of determined to impress this guy, right? And I'm thinking that I'm going to come back with some sophisticated investment strategy or maybe some like jazzy complex tax wrapper arrangement. But here's what happened. After all of that analysis and all the hours that I spent, the data showed me that, well, just something that I kind of wasn't really expecting, right? For 95% of the clients that I analyzed, the absolute most optimal way to build wealth wasn't some fancy investment scheme or something like that. It was maximizing pension contributions, especially workplace pension contributions. And to be honest with you, I was a bit worried because I didn't want to present this. I didn't want to go back to this advisor and be like, look, here's what I've got, because I thought they'd be a bit disappointed, right? Here I am, the eager new guy, and my big recommendation is just put more money into your pensions, right? I assumed that he'd want something a bit more sophisticated and exciting. But when I showed him the projections, he looked at me and he goes, now you're starting to get it, mate. And that is honestly, when it hit me, the biggest money mistake that most everybody that I meet is making, including me, right? Before I saw the raw data, is treating pensions like some boring, stuffy retirement vehicle, when actually it is the single most powerful wealth building tool that essentially all of us have access to. So interestingly, I want to know something. So please, can you be honest with me? Do you currently see your workplace pension as just this boring, stuffy old thing, like I've mentioned? I guarantee you probably do. So let me know in the comments right now. I'm just interested to see what people's current view of workplace pensions is before I crack on. So what I think is so important to understand is how much this actual mistake, this overlooking of workplace pensions, is actually costing you. We are talking about the difference of hundreds of thousands of pounds. And I'm going to prove it to you with two simple calculations in the next section. But before I get to it, very quickly, I send emails to all of my clients to help them sort of keep more of what they earn and convert it into lasting wealth. Tips, hints, tricks, actionable points, everything that I've learned basically over the last 15 years. Now, I'm quite precious about my email list, but I'm willing to let my viewers have access. So if you want to get involved, click the link in the description below and you can get on the list straight away, effectively. So this is going to be a little bit number heavy, okay? But hopefully I'll explain it in a way that kind of makes sense. So just stick with me and you'll see what I mean, okay? Imagine for a second that you are earning £60,000 a year and you decide that you want to save £500 a month for your long-term future. You essentially really probably have two options, I would say. Option one, invest money into like a stocks and shares ISA. Option two, put it into your workplace pension. So let's go through those in order, right? And see how the options play out. Let's go through option one first. The ISA route, this is what most people will do. And this is what most people kind of get themselves into. But here's what most people don't realize. First and foremost, in order to even invest £500 a month into a stocks and shares ISA, you would have had to actually earn about £833 of gross income to actually get £500 into your bank account. Why? Because you're a taxpayer. Because in this case, you're a higher rate taxpayer paying 40%. So you're already 40% down from the money that you've earned before you even start actually investing, right? So let's run the numbers. £500 net per month for 20 years at a 7% annual growth, okay? Told you it was a bit number heavy, but just stay with me. So your total contributions over that 20 years would be £120,000. That's obviously £500 times by 12 times by 20. But here's the kicker. To get that £120,000 into your ISA, you actually had to earn £200,000 of gross income. It's the same as what we said. That's the £833 a month times by 12 times by 20 years. So it's the gap between what you actually earn and the actual amount that comes into your bank account that you can then invest. So just think about that for a second, right? You worked hard for that money and 40% of it has vanished even before you get a chance to do anything with it or invest it. That is tax drag and it is an absolute killer. But after 20 years at 7% growth, because it's invested in, a diversified portfolio of equities and other bits and bobs, that ISA could well be worth something like £246,000. Now, great, I hear you say. Now that works really well. Looks great to me. But keep those numbers in your head because what I'm about to show you is going to absolutely blow them out of the water. You literally won't believe the difference, right? So let me contrast that with option two, right? Contributing towards your pension or any pension, but essentially your workplace pension. So let's assume again that you're earning £60,000 a year. If you put £500 straight into your pension through salary sacrifice, you are only missing out on £300 a month of net pay. Why? Again, because your £500 contribution into your pension means that you're not paying 200-ish pounds in tax and national insurance. So the £500 into your pension is actually only costing you £300,000 of net pay, the money that would have landed into your bank account. But wait, it gets even better. So that was a very 90s TV show, wasn't it? But wait, but look, it gets even better. Let's assume in this case that your employer is going to match that contribution. That means that another £500 is going into your pension as that employer matching. That is literally a 100% return on your money before even the market or investing starts. So a total monthly contribution of £1,000 going into your pension has only really cost you, as in the amount of money that would have been in your bank account, £300. Employer matching is the single greatest weapon that we have to build wealth. It's essentially just your employer matches the amount of money that you put in up to a certain limit, but more on that a little bit later. If that 100% concept return has blown your mind, right, hit the like button below, because it really, really helps me to get this content out there a little bit more, and it helps me to acknowledge that this is actually hitting home and helping you and is something that is useful. So let's run those numbers again for 20 years. £1,000 contribution every month for 20 years, that's a total of £240,000 in total contributions to the pension over the years. But here's what's incredible. It is only costing you £72,000 from net pay, as in money that you could have had otherwise. So you're giving up that £72,000 for £240,000 to actually be in your pension. That's that £300 a month times by 12 times by 20, roughly. So in terms of gross income, so this concept of how much you've had to earn to get that money. So again, it was 833 before, down to 500 that you then invest. With this, you've only had to earn a total of £120,000 gross over those 20 years to make all of this stuff happen. That's 500 quid a month times by 12 times by 20. And after 20 years at the same 7% growth rate, that pension could be worth about £492,000. So look, there's a lot of numbers there and a lot of bits and bobs, and I know it's quite confusing, but the point is this. What does it all kind of mean? Well, it means that you've been working harder, paying more tax, and getting less wealth by doing the ISA route. But the best part is the fix for all of this is absolutely incredibly simple. Just let me highlight the differences here to be 100% crystal clear. With the ISA route, you sacrifice £120 that you could have had access to, right? So that's what you're investing. That's how much you have to actually do out of your net pay. To get £120,000 in your bank, you've had to earn £200,000 roughly to end up with £246,000. With the pension route, you're sacrificing only £72,000 from your net pay. So again, you're giving up much less. But the key thing here is you only have to earn £120,000 gross. And then after all of that said and done, the final projected value of this is £492,000. This is crazy to me. How people keep making this mistake of not being a member of their workplace pension is constantly baffling to me. But what you can see here is the right choice gives you well over £200,000 more wealth whilst only costing you, you can see here, £48,000 less. You have literally doubled your wealth while keeping more money in your pocket along the way. This is the single biggest mistake that everybody makes, that they don't understand this concept. The numbers do not lie. Now, hopefully you understand that, and hopefully you can see the true cost. Let's talk about the cure. So here is a very simple 2-step fix that you can implement today to make sure that you don't do this again. Firstly, step 1, you need to join your workplace pension today, okay? It is quite literally, as I've said, the single greatest asset that you have in your fight of keeping more of what you earn and converting it into financial security and lasting wealth. It doesn't matter who your employer is, or how good you think the pension scheme is, or how trustworthy you think they are. You just need to be involved, and you need to become a member of that scheme. So if you are eligible, make sure you join. Step 2, you need to maximize, and this is the absolute key part, you need to maximize 100% of your employer matching right now. Get in touch with like your HR department or your pension department or your payroll department, whoever it is that looks after your pensions, and ask them to confirm how much the employer matching contribution is. So this is something that most people don't even know. It's something that, they don't take advantage of. You leave free money on the table. If you're not taking advantage of 100% of that employer matching contribution, you're leaving free money on the table. It's like your boss walking past your desk, leaving 20 quid on your desk and you just ignoring it, right? It's crazy. So make sure that you confirm the matching rate. So again, just to confirm, the matching rate is how much your pension provider, your employer will give you in terms of matching your pension contribution. So you put £1 in, they put £1 in. That's how it works. So for example, let's say here, you've got a scenario where you're paying in 5%, they might also pay in 5%, which means you're going to get a 10% total contribution, 50% of which is money that you've not had to earn. So if you're going to check your pension match this week, what I want you to do is actually quantify it. And in the comments below, I want you to type matched. I want to see how many of you are actually going to do it this week and how many of you are actually going to claim this free money. So for example, what you can do is if you get a bit confused or you're not sure how to do it or you want a bit more guidance, just send an email to your HR or someone like that and say, can you please confirm the maximum contribution, percentage contribution that I can put into my pension that will be matched by you? So they'll come back to you and say, hello, we match up to 5% of your salary or up to 3% of your salary, or whatever it is. Once you know that, you can then engage with them and say, right, okay, what am I currently contributing? Can I increase it to that level? Sure. It does involve a little bit of sacrifice today, i.e. you are theoretically giving up some money for today to get involved and to grow your wealth for the future. But you're kind of doing that even if you're taking the money, getting paid, taking the money, going into your bank and then investing it. It's a massive roundabout the houses way of doing it. So just ask the question. You might be surprised. Honestly, I've seen some pension providers, some employer pension providers give like massive bonuses because, again, this is something that is sometimes an employee benefit that attracts people to the job. So you might be surprised. So just check it out, see how good they can be. I've seen people get matches up to like 10%, and that is such a valuable resource. Knowing this, Vix, is just the beginning, right? You need to make sure that you're constantly making good decisions across all areas of a finance, even if you're not an expert. That is why you need to watch this video here next, because I've developed pretty much 3 questions that I've seen work time and time again that you can ask yourself before any financial decision to make sure that you keep yourself out of trouble and avoid making big mistakes. So click the video now and I'll see you there.